Structured notes are usually debt instruments issued by financial institutions like banks. They generally have some form of principal protection, either 100% principal protection or some high percentage principal protection, as well as being linked to the returns of an underlying asset. In this case, we'll talk about the S&P, for example, as an underlying asset. So what the structured note is designed to do is to give investors some comfort about their principal, but also giving them some exposure to the upside of a particular asset class like the stock market or the S&P. There are generally two types. They're generally known as growth or income. Growth is just designed to participate in the upside of the asset, if it's a stock market or commodities or any other type of asset. Structured notes that are considered income notes actually provide a certain coupon or yield with some other caveats, assuming certain things happen in the market. But basically, they're tailored to a certain exposure that people want to get. So why some people like them, some people don't. Some of the positives are they can be convenient. They allow investors to express a certain view. They can be somewhat complicated. But I think the reason some people don't like them is there are invariably a lot of embedded options, and to a sophisticated option trader or derivative trader, I think they would likely argue that the options are not priced to the advantage of the investor. They may be either expensive or cheap and priced to the advantage of the issuer. That being said, not everybody has access to those efficient option markets, so in some cases they may actually be okay for investors. But let's talk a little bit about structure and how we get there, and an alternative to a structured note issued by a financial institution. In this example, let's assume we create a vehicle, a fund, a pooled investment vehicle, and part of the investment capital purchases 5-year zero-coupon bonds. The approximate yield is 4%, which would give the zero-coupon bond a price of about 83%. And I'm just rounding off these numbers, and they change every day based on interest rates. So this vehicle is pretty likely to at least have enough to pay investors back par at the end of the 5 years, because the treasuries will mature at par, and in the absence of some very unlikely event, the custodian fails or some other type of risk, it's pretty likely that investors will get their principal back. Now, having spent in this case $83 on the treasury zero coupon bonds, there's $17 left. Those $17 can be spent buying the S&P, buying S&P futures, buying some other stock index, buying commodities, pretty much anything that an investor wants exposure to. But it's really just arithmetic. What's invested in another asset will appreciate or depreciate. If it depreciates, then investors can expect to get their principal back from the treasury bonds. If it appreciates, investors will get a net return that's really a blended return of 4% on the treasuries and whatever the underlying asset earns.